Credit score, definition, factors, and improving it. What is a credit score? A credit score is a number from 300 to 850 that rates a consumer's creditworthiness. The higher the score, the better a borrower looks to potential lenders. A credit score is based on credit history, number of open accounts, total levels of debt, repayment history, and other factors. Lenders use credit scores to evaluate the probability that an individual will repay loans in a timely manner. There are several different credit bureaus in the United States, but only 3 that are of major national significance: Equifax, Experian, and TransUnion. This trio dominates the market for collecting, analyzing, and dispersing information about consumers in the credit markets. The credit score model was created by the Fair Isaac Corp., now known as FICO, and is used by financial institutions. While other credit scoring systems exist, the FICO score is by far the most commonly used. There are a number of ways to improve an individual's score, including repaying loans on time and keeping debt low. How credit scores work. A credit score can significantly affect your financial life. It plays a key role in a lender's decision to offer you credit. For example, people with credit scores below 640 are generally considered to be subprime borrowers. Lending institutions often charge interest on subprime mortgages at a rate higher than a conventional mortgage to compensate themselves for carrying more risk. They may also require a shorter repayment term or a cosigner for borrowers with a low credit score. Conversely, a credit score of 700 or higher is generally considered good and may result in a borrower receiving a lower interest rate, which results in their paying less money in interest over the life of the loan. Scores greater than 800 are considered excellent. While every creditor defines its own ranges for credit scores, the average FICO score range is often used. A person's credit score also may determine the size of an initial deposit required to obtain a smartphone, cable service, or utilities, or to rent an apartment. And lenders frequently review borrower scores, especially when deciding whether to change an interest rate or credit limit on a credit card. Credit score factors. How your score is calculated. The 3 major credit reporting agencies in the U.S., Equifax, Experian, and TransUnion, report, update, and store consumers' credit histories. While there can be differences in the information collected by the 3 credit bureaus, 5 main factors are evaluated when calculating a credit score: payment history, total amount owed, length of credit history, types of credit, new credit. Payment history counts for 35% of a credit score and shows whether a person pays their obligations on time. Total amount owed counts for 30% and takes into account the percentage of credit available to a person that is being used, which is known as credit utilization. Length of credit history counts for 15%, with longer credit histories being considered less risky, as there is more data to determine payment history. The type of credit used counts for 10% of a credit score and shows if a person has a mix of installment credit, such as car loans or mortgage loans, and revolving credit, such as credit cards. New credit also counts for 10%, and it factors in how many new accounts a person has, how many new accounts they have applied for recently, which result in credit inquiries, and when the most recent account was opened. If you have many credit cards and want to close some that you do not use, closing credit cards can indeed lower your score. Instead of closing accounts, gather up the cards you don't use. Keep them in a safe place in separate, labeled envelopes. Go online to access and check each of your cards. For each, ensure that there is no balance and that your address, email address, and other contact info are correct. Also, make sure that you don't have autopay set up on any of them. In the section where you can have alerts, make sure you have your email address or phone in there. Make it a point to regularly check that no fraudulent activity occurs on them, since you aren't going to be using them. Set yourself a reminder to check them all every 6 months or every year to make sure there have been no charges on them and that nothing unusual has happened. Vantage Score. Vantage Score is a consumer credit rating product developed by the Equifax, Experian, and TransUnion credit bureaus in 2006 as an alternative to the FICO score, created by the then Fair Isaac Corp. in 1989. FICO scores remain the most popular credit score, employed by about 90% of all lenders. However, the use of Vantage Score has been increasing, growing by about 20% annually since June 2015, based on studies conducted by consulting firm Oliver Wyman. The most recent study available, looking at July 1, 2018 to June 30, 2019, found that approximately 12.3 billion Vantage scores were used by more than 2,500 users. Credit card issuers were the most prolific users of Vantage Score, followed by banks. There are several points of difference between FICO and Vantage Score. FICO creates a single bureau-specific score for each of the 3 credit bureaus, using only information from that bureau. As a result, it is actually 3 scores, not 1, and they can vary slightly, as each bureau will have different information about a consumer. A Vantage Score is a single tri-bureau score, combining information from all 3 credit bureaus and used by each of them. How to improve your credit score? When information is updated on a borrower's credit report, their credit score changes and can rise or fall based on new information. Here are some ways that a consumer can improve their credit score. Pay your bills on time. 6 months of on-time payments are required to see a noticeable difference in your score. Increase your credit line. If you have credit card accounts, call and inquire about a credit increase. If your account is in good standing, you should be granted an increase in your credit limit. However, it is important not to spend this amount so that you maintain a lower credit utilization rate. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.